All righty. Got 7 folks already in, which is awesome. We're going to give a couple minutes here to let all the different participants join, and we'll give a little bit of background while we're waiting. If you want to go into the chat, drop your name, drop your LinkedIn, let us know where you're calling in from. That'd be awesome. We can connect with everybody. We'll also be utilizing the Q&A button at the bottom for any questions. And there will be upvotes in there. So if you see anything that you really like or you want to cover, please do so. And then we'll give it a couple minutes here, and then we'll jump in with a little bit of intro of Bionic and Paul at OpStart and team. So thank you for joining us.
Thanks, everybody. Nice to see some friendly names in the room here.
If it's over freezing on the weather side, hit the reaction up with like a celebration, because it's been pretty brutal here in Chicago. I'm not sure where everyone else is from, but it's finally over 20, which is fantastic.
Coming out of the teens is big.
Very lively chat right now. All right. I'll just kick off a quick intro so we could get this rolling by 12:05 or so with Paul taking over. But no, I appreciate everyone joining us today. This is our first of many community chats being brought to you by Bionic Colabs. We're super excited to be able to have Paul Anthony from OpStart here. We'll talk a little bit more about his background and how he's going to help you build, the financial model to help you raise the capital in this current economic environment. Super important and super challenging. So excited to learn from him as well, as my strengths are not on the finance side and they're on the marketing, growth, and product realm. So it's always great to learn from peers and other operators in the space. So, for us at Bionic, we really wanted to start these chats to build community, to build connectivity within the startup ecosystem, especially for early stage founders. It's really hard to be a founder. There's a lot of barriers, a lot of blockers, a lot of ways that makes life a little more complicated, especially in this economic environment where you need longer runways, you need, to control your burn, you need to have better metrics and better fundamentals behind your business to create more durable businesses to last, as it's going to take a little bit longer to fundraise, as well as kind of scale your business. And being able to bring together great experts from many different industries to give their insights, share information, create discussion, create collection and collaboration, ultimately is going to help everyone go further and go faster. And that's really what we're all about, is that the startup community should work together, and it should make it easier for everyone to succeed, because it's really hard when you look at it in the end of the day. At Bionic, we're a collaborative of operators, founders, and people in our orbit, like Paul and others that we'll be bringing together to be able to provide insights and information to help. And we really think that our secret sauce is creating sustainable businesses with scalable growth. As most of us come from the product and marketing background. And ultimately that will allow early stage companies to hit product market fit faster. So a little bit about me, and then we'll jump into the session. I'm Justin Cohen. I know I just rambled there without saying my name, so I apologize. But I've been in the startup ecosystem for now in 2024, 20 years officially, which kind of terrifies me. But I've been an early stage founder, operator, from employee 1 to employee 10, helping to scale companies, running marketing and product from the very beginning to exiting over $1 billion over a couple different companies, and now really focused on mentoring, advising, and investing in the angel perspective with about 12 companies in the active portfolio today. And I'm excited to share and share a little bit more about Paul and talk to you a little bit more about the session. We're going to be recording this, as you saw, so we'll send out this session to everybody to share. We'll put it on our blog. We'll keep it live, and hopefully we'll have some great questions as well. As I mentioned, for those that joined, we're going to use the Q&A section for questions. So plop it into there and not the chat, and upvote it, and we'll go from there. And then we'll be announcing our next community chat at the end of this. So without further ado, I'd like to introduce you to Paul Anthony, who's the co-founder and CEO of OpStart. Previously, he was a VC at Adam Street Partners, a Chicago-based firm that leads Series B to D rounds for tech and healthcare companies. He began his career as an investment banker at William Blair, helping to sell 4 SaaS companies for a total of $1.5 billion over 2 years. Paul is a co-founder and board chairman of a tech non-for-profit called Poignant, has a finance degree from Notre Dame. Say that again. Yeah, sorry.
Puente, Spanish word.
Puente. There we go. I screwed that up. Thank you for correcting me. From Notre Dame, and lives in South Bend, Indiana with his wife, Morgan. And I'll let Paul kind of give a little background about OpStart, and would love to have you kick off the presentation.
Thank you, Justin, for the intro. Thrilled to be here. Honored that you guys all took some time out of your day to join us, and I will try to make this as helpful as possible to that end. As Justin said, helpful to know what you guys are hoping to see from the webinar. So please go hard in the Q&A. We will answer things live. We want to be as interactive as possible, so don't hesitate to ask. I will just share my screen real quick. And pull up a deck that you can all hopefully see. So quickly about OpStart, we are a full stack financial ops support company. We provide everything from bookkeeping to tax filings, fractional CFO services, bill pay, invoicing, payroll, and more, with the goal of essentially allowing founders to focus on what's most important for their business and ignore all this stuff that is essential, but not a differentiator or great use of your time. I have been a co-founder before and a VC, and I gained an understanding for how difficult and annoying this stuff is. So my goal is to help other founders, reach their goals without having to deal with so much work that they don't enjoy. We were founded in 2020. We've raised 2 rounds of capital ourselves. So I've been in your shoes and gone through it. It's not fun, but you can do it. And right now, our company serves over 100 startup clients, ranging from pre-seed through Series C. You can see some logos below of a few of our clients. I wish I had included some of the wonderful people on this call, but I showed some Chicago companies there: Protege, Ascent, and Goose. I know are all Chicago-based. And then just to give you a representation of the type of companies we work with, there's some logos of the VCs that back those companies. A lot of Chicago-based venture firms are partners with us, and we always, try to keep those relationships in good shape too, because it helps you guys have good relationships with your investors when you have good financials. I'm going to talk a lot today about fundraising models, but want to start by noting that financial models can be taken in a lot of different contexts and mean a lot of different things. And I think it's important as a founder to understand the 2 main types of models and be really comfortable with both of them. So for one is a fundraising model. A fundraising model is essentially something that you create one time when you're going to raise, and your goal is to tell a story. Fundraising is all about storytelling, and your model is just one component of that. So you want to make sure that you can communicate it really well, that you don't overcomplicate it, that it's clear and easy to follow, and that it's really optimistic, because I'll get into this later, but you do need to show VCs that if everything goes right for you, there's a path to a really massive exit and return for them. Your operating model, on the other hand, I would build it after your fundraise. Think of it like a budget, but slightly ramped up. And an operating model is meant to be used internally by your team, maintained throughout the year, and designed to hold yourselves accountable make sure you're staying on track to hit your goals, and make better decisions based on knowing what's working and what's not for your business. Obviously, these two models can and should overlap. I'll just quickly note that. You don't want to tell investors one thing and then go manage to something else internally. That's not at all what I'm saying with these two options, but an operating model is a much more detailed month-to-month view that helps you stay on track to hit your goals that you create in a fundraising model. I'll talk about both of these in detail, but to start, I'm going to focus on the fundraising model. So the purpose of a fundraising model, as I noted, it's a simple long-term projection that helps VCs understand your business model and your path to success. Two things I would keep in mind in thinking through the purpose of it. Number one, your goal is to tell a story and explain. It's not to predict. VCs know that you're not going to be able to predict the future, particularly when you're an early idea stage, pre-seed company. It's just completely unrealistic. Everybody knows that you don't take the startup hockey stick projections totally seriously in the deck. So some people over the years have asked me, what's even the point of building a model and a forecast if no one's going to believe the numbers? The point is to explain your business model in a mathematical way, right? So as you build this, you have to understand that the outputs matter less than the inputs. When you talk about the model, you're not talking about, the fact that you're going to hit 100 million in ARR in 2030. You're going to talk about your path to 100 million ARR relies on getting CAC down to this number, being able to invest this much in marketing, retaining this % of clients, and doing it at this gross margin, right? So it's about telling a story really around your unit economics and your business model. And that's far more important than the numbers that actually come out of the model. And then the other way to think about this is think about writing your recipe for success, right? Again, you're not trying to predict with accuracy. You don't want to be totally unreasonable, but your goal isn't to get as close as possible to your actual year 5 revenue, right? Your goal is to explain your business model and to show VCs that you know what's important. And if you get those things right, you have a path to becoming a massive success for them, right? So you can think about it this way. Your job is to show VCs a really optimistic scenario of how the business looks if you nail all these things you're talking about and using as key assumptions. The VC's job is to tell you whether that's realistic or not and decide if the risk warrants the investment, right? So don't be shy about being really bold and optimistic in a fundraising model. You're trying to show what the best scenario future is for your company, even if everybody understands that the base case for most startups is not to become massive successful unicorns. Some basics for building a good fundraising model. I would go for a 3 to 5 year outlook. Typically 5 years is the right time frame. You can build it monthly or annually to get there, but your goal is to make this a simple, easy to understand story. So starting with something as simple as an annual 5-year P&L is really sufficient. You always want to build bottoms up, not top down. I linked this in the deck for anyone that wants to go reference it later. But to quickly explain, a bottoms up model is built from assumptions that drive ultimate outputs on the revenue side. For instance, if you're trying to forecast your revenue next year, a bottoms up way of doing it would be to say, it costs us $1,000 to acquire a customer. We're going to have $100,000 to spend on marketing. So we're going to acquire 100 customers. They're each going to pay us, $1,000. So we're going to generate $100,000 of revenue next year. The top-down way of forecasting revenue would be to say, we think our market size is $2 billion. And if we can just capture 1% of that, then we're in business. That doesn't tell an interesting story at all. It doesn't show VCs how you actually plan to execute. And it's not really a good way for thinking about your business because you don't have a good operational framework to then work off of to say, here's how we get to 2% of our market size. So always build bottoms up. All you need to include in your fundraising model to start, a summary P&L, which means not every single line item from your QuickBooks chart of accounts, just your revenue. You can do it by product if you have different products, your gross profit based on a gross margin assumption, and then your expenses across a few main categories. The categories I personally like to use are sales and marketing, product and engineering, and general and admin, but those can be specific for different businesses. You might put all people in their own category versus breaking them out into departments. Fine by me. A good rule of thumb to keep in mind here is your revenue model is much more important and interesting than your expense forecast, particularly when you get beyond the first year. I'll talk about that a bit more later. Ideally, you want this model to all fit on one Excel tab. That gets back to what I was saying earlier on this is a story that you're telling, and the longer the story takes for someone to read, the less likely they are to actually get through it and come away with the right takeaways. So keep it simple. You don't need to, include tabs breaking out all of your recurring SaaS expenses to justify some line item in G&A. You can just say G&A is 10% of revenue, and that's totally fine. You're not going to be able to forecast how many people you need to hire 5 years from now. Don't bother with it, right? Keep it on one tab. If you need to go up to 3, that's fine. Anything more than that, you are wasting your own time and everybody else's. And then the last point, which is really important, your model needs to be easily adjustable. So no hard-coded figures. By hard codes, I mean numbers that you just type into Excel. You're not creating a revenue forecast by saying 100,000 year 1 and then moving over and typing 120,000 in year 2. You want it all to flow from a few assumptions. Those assumptions should be the only hard-coded numbers in there. Everything else is calculated off of them. And it should be really easy to find your assumptions. I like to highlight them in a light blue background with blue font in the cell personally. And that allows you, when you're trying to test different scenarios, to just go change the assumptions and everything else will filter through. As an example here, maybe you make a fundraising model, you pitch it, you get a little initial feedback, and VCs are saying, I don't see how you can get to a CAC that low. I've got other portfolio companies in your space. They pay way more to acquire a customer. That's great. That's really good feedback to know. So you can go in and adjust your CAC assumption and say, if our CAC is 50% higher, then our revenue just drops by this much in the future years, but we're still getting to cash flow positive by this date and 2 million of revenue by this date and on track to raise our next round. So make it really dynamic, easy to adjust. And by calling out those assumptions so clearly, you're also steering all the kind of conversation and focus towards your business model and core unit economics, which is helpful for both you as, an operator and investors in trying to understand what is going to drive success for the business. Feel free to chime in with any questions along the way. But otherwise I'll keep moving here. Now that you know some of the basics on a good fundraising model, I laid out what I think is a pretty simple 4-step process to building one. I very much understand that every business is different and every model has to be uniquely fitted to the business. So this may not be a catch-all for all of your different companies that you're trying to start out there. I will note that I'm more than happy to do a separate one-on-one session with anybody who is struggling with their model. So feel free to reach out. But this is a 4-step process that I think works for most startups. Number 1, really start by nailing down your unit economics. I don't know if you guys are, familiar with unit economics. Hopefully you are, but essentially they are the key drivers in your model that dictate what your overall financial results will be in the future. For example, if you are, running a lemonade stand and you can sell lemonade for $1 a cup and produce a new cup of lemonade for 20 cents, then that's your unit economic. Your selling price is $1. Your gross margin is 80% because you make 80 cents on each cup. And then your overall revenue and profits just become a function of how many cups of lemonade you can sell, right? So nail down your expected selling price, your gross margin, If you're running like an e-commerce business, then that would be your cost to order a unit of inventory or produce it. If you're running like a SaaS business, your gross margin's way more convoluted. So just assume 80 or 90% that people are fine with it. And then also you're, moving past that piece, I guess, the next piece is how you actually sell more units, which is customer acquisition cost. We'll return to the lemonade stand example. Your profit per cup of lemonade. Now you have to figure out what it costs you to entice someone to come buy a cup of lemonade. And so if you're forecasting your revenue, you're saying, I think I can spend $10,000 on marketing for the lemonade stand. And that marketing cost will get me 5,000 or 20,000 customers, which means that I'll make $20,000 of revenue and $16,000 of gross profit. And my customer acquisition cost would be 50 cents on that. How you sell is also important. I'll come back to that in a little bit. But then the last one, particularly for any recurring or SaaS businesses, is customer retention. A lot of startups these days, it's not just a one-time purchase. You're acquiring a long-term recurring customer. So how much you can spend to acquire that customer and how much revenue they're worth to you in the long run really depend a lot on the retention, how long they'll stick around. So your first step is to really nail down those unit economics. They're the most important parts of the story. They're the key drivers of success. And in the early stages, they're the things you should be thinking about and trying to validate, right? If you've already been in business for a couple of years, it's pretty easy to calculate your unit economics because you can look at actual data and then project how it would scale moving forward. If you haven't started your business yet or had any operating history, it's harder to do that. You just have to draw a line in the sand. You can do research on what others in your space are seeing and talk to people to try and get some validation. But ultimately, you just have to make a case and be ready to adjust it quickly as you learn more. Once you've decided on those unit economics, write them down, note how you calculate them and all the assumptions that go into it. Then you can go into more of a sort of budgeting process on allocating your first year expenses. Again, looking 5 years down the road, you have no idea how many people you're going to need to hire and how you're going to have to spend your money. For the next 12 months, if you raise a successful round, you probably know where you're going to put those funds, right? So you might know that if you raise $1 million, 500K of that needs to go directly to building your product or creating a prototype or conducting a clinical trial or something like that. Block that out of the budget right away. You might know that you need to start paying yourself a salary and then hire 2 more team members who are on the executive side. Block that out from the budget right away. Put that in your first year expenses. Your goal here essentially is to figure out what expenses you have on the horizon and then put everything else into sales and marketing. I'll get to why that's the case, but essentially your sales and marketing expense drives how fast your revenue is going to grow. In this exercise, definitely be directional, not exact. When we get to the operating model, we'll talk about building your exact expenses out and really budgeting for that. For a fundraising model, again, keep it simple, high-level buckets, high-level estimates. Your goal is just to figure out how much you can afford to put into sales and marketing. And then your next step here is to tie the top 2 pieces together in order to forecast your revenue. So if you just take all the unit economics we went through and plug in your sales and marketing budget, you have your revenue forecast for year 1. That's it, right? You multiply your sales and marketing expense by your CAC. That's the number of new customers you're going to add. Your new customers plus your retained customers, which requires that retention assumption we talked about. That gets you to your total number of customers. Your total number of customers times your selling price is your total revenue. Your total revenue times your gross margin is your gross profit. Please feel free to chime in if you have any questions on that piece, but that's why the unit economics are so important and why you need to do some work on expenses before you go do the revenue forecast. But once you've done that, the rest of your future years, use very simple operating expenses. I like to generally just scale them by category as a declining percentage of revenue. So your first year, you kind of know the budget and you have very little revenue. It doesn't matter. As you move towards year 5, a good rule of thumb would be to take your G&A to like 10% of revenue, your engineering and product somewhere in the 10 to 20% of revenue, and your sales and marketing similarly in that 10 to 20%. Definitely encourage you, if you want to sanity check this, just pull up some public company financial statements in your space. If you're like a software company, it's really easy to see what an average gross margin is for software companies, and then how much of their, budget otherwise is dedicated towards selling versus, internal operations versus, continuing to build and maintain the product. And you can scale your operating expenses towards a similar kind of portion of revenue. You do these 4 things and you actually have a really simple P&L that you can carry forward over 5 years. You want to keep maximizing your sales and marketing budget in order to show the highest possible growth. And at the end of your P&L is your net income. Use that as a proxy for your cash flow, right? Figure out when you'll run out of cash if your model says you will, which most of them, in my experience, are so ambitious that they have you getting profitable. Just understand sort of your next milestone, which is typically the year 1 or year 2 totals on where you want to be from an ARR standpoint, how much cash you've burnt in order to get there. And that will help investors visualize kind of the path towards your next big fundraising event or just being profitable. That was a lot of stuff. So, Justin, is there anything in the Q&A that we should go over?
We have one question, I think, that will relate here, and a second question we'll answer at the end or close to. But we have an anonymous user here, individual that's interested in understanding your recommendations on cash model projections, especially as a product business with wild cash swings for inventory. Example, no stable monthly burn. Investors seem to be quite interested in detailed cash modeling these days.
Totally makes sense. And a lot of my standard tips here are a little bit more focused on, software fintech type businesses that don't have that type of inventory component. So I'll talk about that for a second. Generally speaking, if you simplify your model to make it a really easy story to tell, then you should do it on kind of a smoothed out, steady state accrual basis, which means instead of looking at when you need to add inventory and then how fast you sell it, and then when the cash hits for your next inventory order, and so on and so forth, you just want to look at, on average, how much money you make from each product sold and scale that forward, right? But to your point, that's not how it's going to work in reality for your cash balance. So it's helpful, definitely if investors are asking it, and most certainly for your internal modeling, which we'll get to after the fundraising section, to also build out a monthly view for your first 18 to 24 months, which is typically the cycle of how fast you'll burn through your first financing. Go through that and do a detailed monthly cash-focused forecast. So if you're selling a physical product, that means timing out when your inventory will run dry and you'll need to reorder, so you have cash for that. If you are conducting large enterprise sales, or you have a SaaS model where you're collecting cash upfront for a 12-month license from customers, then you can factor that in too, because that is different from your revenue. The timing that you receive cash and send it out does matter for knowing how long your runway will last on this financing. It actually shouldn't be part of the story from a long-term sort of 5-year view. I would exclude that from that view, but you need it to get to the finish line on your first financing. So you could kind of prepare it as a separate analysis is what I'd say. Again, the fundraising model, I think, stick high level to just tell the story of your business model. You can absolutely include another more detailed 18, 24-month view that kind of aligns with the fundraising model and shows the exact timing that you expect various kind of cash needs to hit. We'll talk about that piece in the operating model section that comes after this. So when we get there, whoever asked the question, just keep that in mind, that you can build an operating model in advance of your raise and kind of use it alongside the fundraising model. All right. So now that you've followed these 4 steps and built your model, some ways that you can perfect it. Number one is just to iterate as much as possible and test your scenarios. This is helpful for a few reasons, and gets back to one of my early pieces of advice to make it as kind of malleable as possible and driven just off the minimal number of assumptions. For one, you do need to get to a certain output of the model in order to attract VC investment specifically. Investors have different goals, so this won't apply to everyone. But VCs, as I say in this next section here, typically want to see that you can become a unicorn level business, get to $100 million of ARR, and grow at what they call kind of the triple, double rates, which is 3x in year 1, 3x in year 2, 2x in years 3 and 4. It's okay for you to build starting with assumptions that you think are realistic, and then figure out how much more aggressive those assumptions would need to be in order for you to hit 100 million of ARR and follow a triple, double, path. It's good to know that internally, right? And then the second thing is your assumptions have varying degrees of sensitivity to the future success of your business. And testing scenarios helps you find out which ones are most important, which then dictates where you should focus most of your time as a founder, right? So you might test scenarios to say, how does our growth look if we increase our prices, but also increase our CAC? If it takes us, twice as much money to sell a new customer, but we sell a new customer for twice as much money, what does that do to the forecast, right? How detrimental would it be if we can only manage to produce our units at a cost of, $30 instead of $20, which means our gross margin gets cut in half? Plug all those scenarios in on your own, test them out, and that will help you answer questions once VCs actually get with you live and start talking through this. A key thing to know here is, again, because everybody involved knows that these models aren't super predictive and you're just telling a story, you should be able to talk really intelligently about the key elements of that story, these key assumptions in unit economics. And it's really impressive to VCs if you can show them that you've already thought through their concerns before they did, right? So test the scenarios on your own, figure out what assumptions you can afford to kind of miss on a little bit versus what ones you absolutely need to get right. And that will help you tell a better story and manage your business better too. Second one, I kind of mentioned this, but know your audience, right? If we're talking specifically about VCs, I mentioned they kind of want to see a path to unicorn potential, and that means massive growth over that time. Not the case for every investor, though. The question that we just answered from the chat is a good example of this, right? Particularly in today's environment, a lot of investors are more focused on, cash efficiency. And if your business is one that is a bit more cash flow intensive, and you're pitching to investors who maybe are individual angel investors that don't have quite as high of a risk tolerance and aren't making as many bets, or more kind of corporate investors who are used to seeing traditional kind of cash flowing businesses, right? Then maybe that's not the way you want to build your model, right? Maybe you want to build your model to be a little bit more conservative on growth, optimizing to get to profitability quickly. If you think this is the only VC fundraising round you ever need, definitely do it that way, right? Optimize more for cash conservation versus growth, and focus more on that side. And then finally, I hinted at this above, but prepare to defend your assumptions. As you build out your unit economics, think through which of them seem proven, that you've already validated based on your operating history, and which ones are really unproven. And for the unproven ones, explain how you got to your estimate, whether it's market research, talking to other people in the space. You ran a test campaign with Facebook ads, with $200 of your own money and found that you could, get a click at a cost of $3 per click. Whatever it is, just have an explanation for how you arrived at an assumption. And then know, as I mentioned earlier, which assumptions matter most. So back to your unit economics. Is this a business that really needs to get CAC down to $10 in order to work? Or is it one where you have some CAC flexibility and some pricing power, but you need to figure out how to produce your product for a low enough cost to make money on it? Figuring out which of the assumptions are most important, again, just helps you focus on the right things and tell a good story when you're talking to investors. And whenever investors start to hop on and question you, always steer the conversation back to unit economics. I've actually found that a good way to weed out bad investors who aren't going to be super helpful and focused on the right things is to look for which ones question the outputs of your model versus asking about the inputs of your model. If you ever hop on with an angel investor who doesn't do this much and looks at your forecast and scoffs at it and says, I don't know how you're going to do $10 million of revenue 2 years from now when you're pre-revenue today, like that seems insane. They might be right, but that they're missing the point, So again, I just included an example here, but you get a question like, how do you expect to hit 5 million ARR next year? That's crazy growth. If your answer is, well, we already have a sales rep who brought in 1 million of new ARR this year. We're going to use your funding to hire 4 more sales reps immediately. And if they're all equally productive, we get to 5 million of ARR. Pretty tough for the investor to question it, right? They might be able to say internally, well, maybe 1 or 2 of those reps don't work out, or they're not all equally profitable or whatever, but that's fine. The onus is on them then to question it. And you've proven that you've thought through this and have a really logical basis behind your forecast.
It's a good point here. There's a question, I think that jumps into this a little bit or delves into this. How should I present the financial model to potential investors? Do I present the assumptions outright ahead of sharing the model? Should it be something we even present or just in the data room?
Absolutely. Here's what I'd recommend on that front. Build the model in Excel. Then in your pitch deck, you essentially need to include typically 2 things, maybe 3 things. One is just a high-level summary of the outputs from the model, which is typically just a graph that shows revenue going up and to the right. You want to show the key assumptions and talk about how you got there. So as you show revenue going up and to the right, below it, you can have some, big numbers that are your metrics that show, hey, this forecast is driven off the assumption that we can have a CAC of $2,000, an average, annual license price of $10,000, 90% annual retention, and an 80% gross margin or something like that, right? And so I like to list the most important assumptions in unit economics right in the deck because it kind of front runs their questions and shows that you built your model the right way. It makes that hockey stick up into the right graph not look just stupid and useless, but look like the product of some real thought and, consideration. And then the last thing, which this doesn't necessarily come from your fundraising model, but it plays into it, is you always want to show where this initial first round of funding will take you. So if you're raising a pre-seed for $1 million or something, and you're planning to go to market as soon as the funding hits, you can pick a spot on the graph and show, our first funding we think will last us 2 years and take us to 3 million ARR. And when we hit 3 million ARR, we're going to be positioned to raise a Series A, something to that effect. Otherwise, on presenting it, what I would say is if you built your model well in Excel, following kind of the guidelines I laid out, once investors express some interest and want to engage in more diligence, just send them the live Excel model. There's nothing more annoying and pointless than getting like a PDF export or acting like your model's some sort of trade secret. Just share them the live Excel version, and you can, they'll probably get how to edit it themselves if you've called out assumptions clearly. So they can actually go in themselves and plug in their own scenarios to build their own cases to say, okay, I think even a more conservative case gets us a decent return on this, and the upside case makes sense, and we're good to go.
We have a quick build-off question.
Yeah.
Are there any questions on use of funds that you'd be prepared to answer?
When I think about use of funds, there are a few ways to take this, and it totally matters by stage too and by company business model, right? So first of all, your use of funds should be some sort of indication of your priorities within the next year or two, right? I focused most of this conversation on businesses that are ready to go start generating revenue. But if you're building like a life sciences startup and trying to develop a drug that you'll commercialize way down the road, obviously the revenue piece doesn't even matter, and the use of funds is way more important. And the milestone you get to from it should be something like, phase 1 FDA approval instead of 2 million ARR, right? I would generally just think through your own priorities of, if the funding hit your bank today, what seems like it's most important. And some people like to then go build out a really detailed list of, I'd hire for these roles at these salaries, and, start working with these vendors and order this inventory. And that's a fine approach to take. Another approach to take is if you can just go high level and say, if we raise $1 million, our primary focus is product. So we would allocate a $600K budget towards engineers and designers. We would have $200K reserved for the executive team, which is, myself and one other chief of staff. And then we have another $200K that is cushion and sales and marketing test fuel for when our product is ready to be commercialized, right? The later stage you are, once you're post revenue, one thing I would keep in mind is, particularly if you're a founder with more of a product background, I think a lot of founders maybe over-index towards product budget and adding new features and talking about what they can do on the product side to make their offering more interesting and high-powered. Don't underinvest in sales and marketing. I would say if you are post-revenue, the more fuel you can put onto your sales and marketing engine, the more likely you are to hit your next fundraising target, raise a much larger round, and then have a larger budget to work with between, making your product the baby you dream of, and continuing to pour fuel on that growth engine. I don't think use of funds needs to be included in every slide deck. I'll say that. It kind of depends on your audience. Again, investors who are a little bit more cash flow focused and operationally inclined will probably want to see it. If you're pitching to, blue chip VCs and that they're familiar with the startup uncertainties, for instance, they really just care about the fact that you're a good founder and your idea, business model, market makes sense. They'll trust you to allocate the funds as you see fit, and you can be prepared to just talk about that, in a conversation when you're pitching if it comes up. I don't think you always need to include a detailed breakout, but it does make sense in some cases.
Perfect. Thanks.
Yep, you got it. All right. That was the end of our section on the fundraising model. So if you have more questions on that, please feel free to toss them into the chat and we'll get to them later towards the end here. But I'm going to keep it moving for the sake of time and quickly run through your operating model. As I hinted earlier, your fundraising model is something that you do to really drum up interest and write your recipe for success and tell a good story. The operating model is something you use internally to actually hold yourself accountable to hitting that story. You're going to be intimidated when you create a fundraising model that shows you, getting to 5 million ARR within 18 months or something like that. So the best thing you can do as soon as the funding comes in is take your current starting point, take your ending point that you pitched investors on, and then figure out the path to get from point A to point B. That's what your operating model is. It's more detailed. It includes a, more granular budget on the expense side. It might include more granular revenue details to break out, your CAC by channel or something like that. But it's really just a map that gets you to where you want to go. And it's used to assess your progress. Think of it as like your Google Maps, ETA as you're driving. Your operating model tells you whether that ETA has changed and where you'll actually be able to get within your allotted time, right? Just use it to understand what's working, what's not, and what you need to do in order to hit your goals. It's going to be a shorter time frame, 18 to 24 months. Definitely build it monthly. You still want to go bottoms up and use most of the same assumptions you had in your fundraising model. You can include a little bit more detail on your P&L. And then the important piece is you're updating it monthly to compare it against actual results and figure out how you're performing relative to plan. Similar process to build this, but I would say start by just plugging in actuals. If you have good, books right now, just take your P&L from QuickBooks or whatever you use that as the starting point, build a list of all your employees and contractors and their kind of cost per head in a table, and then work from there. You can budget out your expenses in much more detail. I give some advice there on how to do it, but essentially it's just start with anything that you have on your immediate horizon. If you're aware that you need to order inventory or make a key hire or something, plug that in. And then for other line items, you should be able to logically determine, if it's your SaaS spend, that's probably a per employee cost for the most part, because you need to buy licenses for everyone. If it's your cost of goods sold or something, right, then it's more of a percentage of revenue. So figure that out line by line. You can refine your revenue build, as I mentioned, by adding a little bit more detail so you can figure out, if you're not growing, is it because of retention or customer acquisition issues? If it's customer acquisition, what channels are working and what ones aren't? Let's double down on the channels that work and stop spending on the ones that don't. And generally just work towards the goal that if you miss your forecast, it's easy to see why. The final step there is just iterate from your starting point using your assumptions until the end goal in 18 to 24 months is equivalent or better to the milestone that you pitched investors on, right? You know some things for certain, your target, how much cash you have to get there. You can adjust all the growth drivers and budgeted expenses and just make sure you hit the target with 6 or more months of runway remaining. To perfect the model, some tips I would say, number one, just start with what's most visible next 6 months, and then rely on the same unit economic assumptions from there. For the sake of time, I won't go through all this, but you'll see it in the deck if you read it separately, and involve your team. For one, in any budgeting process, you want the people who are like department owners to weigh in on what they're going to need cost-wise in order to succeed. And then more importantly, you need your team to be bought in on the same goals that you're working towards, right? So showing them we pitched investors on this ambitious mission to get here helps them get motivated to do their part to bring you there.
Paul, we had a quick question on the operating model. So do you ever share your operating model with investors once they've invested?
Yes, particularly board members. I think it's really helpful to go through an operating model with your board in every meeting, certainly at least once a year. And if you have investors that are kind of leads that are particularly active, right, then you can pull them even into monthly meetings to analyze it. Sometimes I know as founders, we have a tendency to want to tell investors a good story and avoid, incurring their wrath. But the more transparent you can be with them, the more helpful they can be to you, and the better chances you have of raising your next round, even if you're off target, because they'll see you as an honest operator who's trying to improve rather than someone who's, hiding bad news and just trying to give you positive spin on everything. And that actually ties in well to kind of my tips for maintaining an operating model. A forecast model for fundraising, you create it once before your round, and then you look at it from time to time and use it as a template before your next round, but you don't really use it internally otherwise. An operating model is an internal tool that you use all the time, right? So stick to a monthly cadence of plugging in actuals, analyzing variance between your expectations and reality. If any expense line items differ by more than like 10% versus your forecast, it should be really easy to pick out why. If a revenue miss happens, should be really easy to figure out if it was due to high churn or not enough new customer acquisition, and what channel of customer acquisition or segment of your customer base might be the problem. You're going to want to discuss, strategize, and adjust, which gets to the question that was just asked. Figure out who on your team needs to be involved in this. It might be other kind of leadership team members. It might be a board member, an advisor, an investor, but have someone that can be your thought partner on this and go through it with them. As you do that, just identify what's working and what needs to be fixed, and use that to set your priorities for the next month or next quarter, right? And at a certain point, you also need to assess whether the overall plan remains realistic and adjust expectations if not. That gets back to what I just said on it's better to give investors bad news early. So if you're not going to hit 2 million ARR, like you said, and you're going to be closer to 1, tell them up front. Don't tell them when you're running out of cash, because if you tell them early, they might have helpful ideas and they're going to be more willing to give you some bridge capital that helps you get there. Be honest and transparent. Lastly, the goal of this is to help you actually get to where you want to go, not to just create buzz and optimism and bring in some money. So if something isn't working as planned, accept it early, iterate while you still have ample runway. There's no conversation that's worse for me than when one of our clients comes to me saying they're running out of cash and they need to raise a round, and how can we spin their metrics to tell a better story? You had been checking those metrics a year ago when you first raised the round and then looking at them monthly, you would have actually had time to try new sales strategies to improve your CAC or try new production methods to lower your COGS. If you're trying to massage the data at the end, it's pointless. So learn your lessons early and actually make operational changes to improve. And I already covered this, but keep your investors informed and they're going to be your advocates. So that's the end of the structured programming. I will quickly say, as I mentioned, my email address is here. You guys are all going to get this deck. If you want specific advice on your fundraise and your operating model, more than happy to help. Otherwise, would love to field some questions with our remaining time here.
All right. Got a question come through, and so we're both saying a great job as well, Paul, and I agree. I see a lot of investor updates monthly via email. Do you think that's helpful? Do you have a format you like? What's your thoughts there?
Yes, this is actually something I am trying to solve at OpStart with our software, where we send all our clients monthly reports that we think they should just share directly with investors, and we're happy to help them do that in an easier fashion. But generally speaking, I'll say this on investor updates in general. Number one, they are super helpful. Investors, if you follow the discourse on Twitter and whatnot, believe that the founders who send more regular, quick updates are far more likely to succeed than those that don't. So there's some reputational benefits to sharing them a lot. I mentioned earlier the transparency side, that you're more likely to get good help from investors if you're telling them your problems. So I think that's an important piece. I would caution against being way too detailed in your investor updates. And I also think it's okay to segment your investors across some different categories, right? If you have angel investors who put 5K into the company and aren't really involved strategically, I don't think they need a monthly update. You're welcome to give them one, but you might want to include more sensitive information, and the more people that see it, there's a higher chance of leaking. Your primary investors who are writing the biggest checks, taking board seats, wanting to be involved, I do think it's nice to update them more regularly. So I would opt for, as a general rule of thumb, like your first year or so, if you can do monthly updates, that's great. Beyond that, you might want to switch to like a quarterly cadence, and eventually potentially reduce even further, just because they do take some time. And the other thing is, try your best to be consistent with your investor updates, which means pick your metrics out of that operating model and show the same metrics in every update. Because again, if you're just picking the most positive things to share, you're not going to get any useful help. You're basically just trying to pound your chest and advertise. So be consistent, share the same stuff, and always include asks for help, because investors, by and large, I think, want to be helpful, but they don't want to get in your way. So if you tell them what you need, you're more likely to get advice that's useful, or intros, so on and so forth.
Yeah, that's a great point. I think there's a lot of parent-child type relationship, right, where people don't want to send the information because they think they'll, create a problem, versus that'll actually help them solve the problem, and things that they need to do at that stage. I had a founder ask me, they're early, they're looking at an investor wanted kind of a quarterly update, and what type of package of information would you typically send in the more formal quarterly update?
Yeah, what I like to do personally, we have board meetings every quarter, right? And I need to prepare a lot of detailed updates for every board meeting, both financially, metrics, and then just strategic kind of priorities and accomplishments. That's a really good excuse to send your detailed update. So what I do, and I don't know if this is best practice for everyone, is I build a board deck and then I go in and delete some slides that are kind of superfluous and take out anything that's a little bit more sensitive and should be board only, and just send the condensed board deck out to investors as my quarterly update. I'll sometimes include some kind of bullets and written overview as well with it, but that's a good way to avoid duplication of work, right? And just do it a bit more efficiently. And I do like the notion of having your monthly updates be a little bit more short and sweet. You know, any key hires, update on the same metrics every month, asks for help, new product features you launched, anything like that. And that's it, right? Your quarterly one, you can include like your full financial statements. I think that's always nice. You can include a few more metrics. You can include a few more updates. You can talk about what you're focused on next. So that's a good approach too. I like it.
Awesome. Well, I know we're running out of time and no further open questions here, but I think this was an incredible chat. Really appreciate the time, Paul, spending with the Bionic community here. As mentioned, we will send out the recording on the deck, and if you want to reach out to the OpStart team, please feel free to do so and tell them Bionic sent your way, and I'm sure they'll take care of you. One quick announcement we do have is coming up on February 15th at 1 p.m. Central Time. We're going to be bringing on Peter Walker, who's the head of insights at Carta, to talk all things fundraising, fundraising strategies, where the safe rounds are leading at as in the pre-seed and seed round, and where the overall environment is heading. So we're excited to do that. We will send out the registration for that, and we'll continuously have monthly chats ongoing. We do have one quick question people could drop, but I might as well answer it if we in the remaining time. As a CS grad with a focus on product ideation, I'm looking for efficient methods to learn startup finance essentials. Can you suggest key resources or strategies for quickly understanding the fundamentals?
Yeah, most definitely. For one, just shoot me an email because I have some stuff I've personally developed for other, webinars like this, and just for different clients who have asked that I can send you, that covers more than just financial modeling, but the basics of kind of startup finance and whatnot. And then I would also say, I'll look for this and can send you some resources, but there are some good newsletters and blogs you can read that cover this topic. I tend to think that VCs who have a long history of good accomplishments in this space can write some good stuff about it. And if you look at any investors who have backed companies in the sort of startup finance space, so investors in like Brex, Ramp, Pilot, Intuit, no matter, like, find companies like that, OpStart for that matter, they often publish write-ups talking about their thesis on a space that will talk about some of the problems entrepreneurs previously solved that this product helps with. So that can be a good resource as well. But ultimately, like, I'm happy to have a call with you and chat through it. And the best way to learn is generally by doing. And shameless plug, you do need someone who knows their shit to help you. So if you work with OpStart or another company like us, your job's going to be a lot easier in that regard.
Awesome. Thanks again, Paul. And we will send this out, and we appreciate everyone joining this first Bionic community chat. And we'll talk to everyone hopefully on the 15th. We'll see you in the next conversation. Thanks so much.
Thanks, Justin.